Okay. Okay, so basically what we're going to do right now, so we've all seen the lecture on the efficient frontier, and what I'm going to show you is how that actually looks like with the real world data, and how to get this data, and how to process it. And again, I will be doing that in a most simple way that that any person can do. If of course, banks and investment funds, they're not doing it that way. They have automated solutions that get this data from Bloomberg automatically, but we will do as if we're taking the investment decision of our own, and we want to and we don't want to build anything overly complicated. So let's start with two stocks, and that would be the basic case. So guys, I need two stocks. So ideally, one should be intuitively low risk, and one should be intuitively high risk. So any ideas on that?
Treasury bills.
Let's go with stocks. So let's because treasury bills are actually considered risk-free. So we ideally need both.
Procter and Gamble.
Okay, which would be sort of low risk.
Yes.
Yeah, and something high risk like Tesla.
How about Virgin Galactic?
They're not public, so we wouldn't be able to get data for them. But we can take Tesla. That would be probably pretty risky.
When you say high risk, is it high risk right now, or do you mean high risk under any condition?
Yeah, well, so that's the point. So let's get the data and see what the data will tell us. So I hope you can see my screen. Let me know if you don't.
Yeah.
Okay, so what I'm doing, I'm on Yahoo Finance, and I'm basically just going to a Procter and Gamble, and there is this nice tab called historical data. So what it allows me to do, it allows me to download stock price for some, basically I can download everything, but let's use 5 years. I don't want to go too far in the past, because I want to have some data that that is relevant. And that is when we're doing that in reality, that is a judgment call. So how much data we're using. For example, if we are using, and all our measures, both risk and return, they would also depend on what kind of periods are we taking. So for example, if we use daily prices and daily returns, so the stock might have one measures of return and volatility. But if we're looking at annual, it might be different. So basically what we're using should more or less resemble of our trading strategy. So if my trading strategy is to buy stock and sell it tomorrow and then buy something else, then I would probably use daily. If I'm buying stocks for my retirement, then I should probably use annual data, which is not even here, so I will have to calculate. So for now, let's assume that we are medium-term investors, and we would use monthly data. So 5 years worth of monthly data for Procter and Gamble, apply, and I'm downloading it. And the second one, let's get Tesla. So basically same thing, go into historical data. Uh, 5 years worth of data, monthly, and downloading. Okay, so now I have data, and I can share my Excel now. And now you should be seeing my Excel instead. So let's look at,
Andre, the reason you avoided the dailies because you didn't want too much volatility?
Well, it's not because I want to avoid it. Or I could use daily as well. So that basically this is like what data we're using as a judgment call. And this judgment is basically based on what kind of investment strategy I'm looking at. So because we're looking at measures of risk and return when for a particular period. So we're looking like how volatile the stock in 1 day's period. For example, if you're looking at the stock market as a whole, it might be fairly risky, like when you look when you look at it like monthly, and much less risky if you're looking at periods of like 10 years. But not everybody can invest in 10 years. So these time frames that we're using to calculate risks and returns, they should be more or less the same as the time frames that we're looking at our investments. So if I'm looking to invest for a couple of months or for several months, then monthly calculations would make sense for me. If I'm building a system that would be doing like daily trading, would be selling stocks, like buying them today and selling them tomorrow in a few days, then I probably need like some daily measures. If I'm buying and selling multiple times a day, then I probably need to take some like smaller periods of time, like hours or even like 15 minutes periods. So basically the rule of thumb, like what is your investment strategy? Like, and just make sure that whatever your calculations you're doing, they match your investment strategy. You don't know for sure, but like make some reasonable assumptions. Like at least, you know, I'm going to hold them for months, for weeks, for days, or for several years.
Okay.
Okay, so now we got this data, and can you see my Excel now?
Yeah.
Mm-hmm. Okay, so I have my Tesla data. And I have my Procter & Gamble data. Basically, I just okay, so what we have here? We have dates, we have open price, we have high and low intraday price, and we have closing price. Basically, we are not going to use anything but the date and the closing price. So the first thing that I would calculate, and those, as you can see, like first of every month. So the first thing I'm going to do, I would calculate monthly returns. And monthly return is price for this month minus price for the previous month divided by the price for the previous months. So that is basically my return. And I'm doing exactly the same thing for, so that was Tesla. Do you remember which one I exported first? I think the Procter & Gamble was the first.
Yeah.
We can actually look. We can actually look at the price and see. So Tesla should be in high 600s. No, that would be Procter & Gamble. And yes, and that would be Tesla. Yeah, and okay, that would be Procter & Gamble. Okay, so now we have returns, and we can do the same for Procter & Gamble. And feel free to stop me and ask questions if any of those doesn't seem to make sense. So now we have all these monthly returns for 5 years worth of data. So basically we have 60 data points. Now we can calculate what is the mean return, which would be our, and basically that's our expected return, because that's the best expectation we have. And we can calculate volatility, which is our measure of risk. And we're just taking standard deviation of those numbers. And I will just copy paste that so that I don't have to copy formulas. Okay, so now we have two stocks, and for the sake of seeing them together, so I have return, I have risk, I have Tesla, and I have Procter & Gamble. I will just copy them to one sheet so that we can look at them side by side and see if that makes sense. Okay, so that's what we see, right? We see that, and remember those are monthly numbers. So we see that for Procter & Gamble, we can expect about, and maybe it would be easier if I just put percentages, like as a the same number, I just showing them as percentages. So we can expect that Procter & Gamble would give us a return at 0.8%, and it will have a risk of 4.2%. And for Tesla, we can expect much higher return, as we expected, 2.8%, and much higher risk, which is about 15%. So is it obvious to you why actually we are taking standard deviation, and why are we using this as a measure of risk, and what those numbers are actually telling us?
So 2.8, that seems very low for Tesla. How much it has?
That's monthly. Okay, keep that in mind. So that's that would be about 30% a year.
Oh, okay, okay.
So in this case, when we're talking about risk, I mean, we are really talking about volatility, right? Like the ups and the downs, right?
Yeah. So basically, we are saying that so what our standard deviation is telling us. Standard deviation is telling us that if you remember this normal curve and with standard deviation, we're saying that if we assume that returns of the stock are distributed normally, and actually we can take a look. So like how this assumption, how reasonable it is. So how are those returns are actually distributed? This is a very fair question. So is it something that actually resembles normal distribution? So let's look at that. So, and that's what we see. So it's not entirely normal. So
it's like this. It's CEO.
I want to add slightly. Yeah. So we see that it has much wider right tail, but it is like stock returns are not normal, but they are somewhat close to normal enough so that we can make the same as we can use the same logic as we used for the standard deviation. So what the standard deviation was telling us is that I don't have a fancy iPad, so I would have to you will have to look at my ugly. So if you remember this standard normal distribution, we were saying that it's centered at mean, and mean for Tesla is 2.8. And within 2 standard deviations lie 95% of the results. And now we are looking, so how wide is 1 standard deviation? And 1 standard deviation is actually 15%. So 2 standard deviations are actually 30%. So 2 standard deviations are 30%. So that would be some 33 approximately, and that would be minus 30, like roughly. So what are we saying about Tesla? So those numbers, they're basically telling us that if we're investing in Tesla stock for 1 month, we can expect that we will get a return of 2.8% on average, but 95% of these cases would lie between like minus 30 and 33%. So they like, if we're investing for just 1 month, we are fairly likely to lose 30% of our money, or to win 30% of our money. So that is, to a large extent, this is a gamble. So that's the logic why we're using standard deviation as a measure of risk. So it is basically telling us, so if we're investing in, for the period, like now we're looking at monthly period, but we're saying, hey, for just 1 month, we can expect that the return is positive, which is good, but at the same time, we can like lose 30%, win 33%. So, and we can calculate that for any number, but that is quite wild. So for Procter & Gamble, those numbers are 0.8% as a mean. What has happened? There's something. I somehow lost ability to draw. Okay, so I will type them. So we're saying that for Procter & Gamble, 0.8% is our mean. So that's our best guess. And within 2 standard deviations, standard deviation is 4.2. So that means that 2 standard deviation is 8.4. So that's 9, roughly 0.2. And minus 7.6. So basically it's saying like that's the way we're interpreting this as a measure of risk. We're saying that, hey, we're likely to get like about 1% monthly, but the worst case, we would probably not lose more than 7.6%. So, and that is basically how we're measuring risk. And that is especially important if we're trading on margin. And if, for example, we have like 3-to-1 margin, we cannot afford losing more than 30% of our money because we will get the margin call because our equity will go to 0. So we need to have a portfolio that will give us not more than a given maximum risk. So
you might want to explain what trading on margin is for people that don't understand. And margin calls.
Yeah. So what that basically means that we so what that means that we're lending money from the bank. We're borrowing money from the bank. So let's say, for example, that I have, let's say, $100,000. So that's my equity. That's what I actually have.
I'm the broker, right?
No, I am me. I am just like that's me. I have $100,000 and I want to do some risky trades. So I can invest this like $100,000 in Tesla and for a month and get to 0.8%. So let's say I'm investing in Tesla and I am getting 2.8%, which would be $2,800 return, expected return. Let me see. So what is my risk in this case? So my risk, as we have seen, and let's say that I believe that everything is reasonable, and I'm not looking at the numbers outside of this 95% confidence interval. So I believe that market would be like, I am fine, like everything can happen, but I'm fine being 95% sure. So I'm 95% sure that I wouldn't lose more than 30%, which is $30,000. So that is my maximum loss. So that's basically my risk management. So somebody asked about risk management, so that's how I am seeing that. So like, what do I do if I want high expected return? I can borrow money, right? So let's say that I want to borrow, and my broker is giving me 3 to 1 or 5 to 1, let's say 5 to 1 margin. So that means that if I have $100,000, my broker would allow me to borrow another 500,000. So that's I am borrowing. Now I'm investing $600,000, and my expected return is now 2,800 times 6, and I need my calculator here. That's 168,000. No, 16. Yeah, that's right. $16,800. Well, much better, right? So return on equity now is 16%. Amazing business. But what is my risk now? So my risk now, it also is multiplied by 6 because I have invested $600,000. So that's $180,000. And that is bad, because my maximum loss is actually more than my equity. So I am fairly likely now to lose more than what I have. And that is probably unacceptable, because if we're doing that like many times, I would probably end up with getting margin call and losing everything. So even if it will revert to mean after that. So I might say, like, what are the options then? I might say I probably don't want to borrow 500,000. I would borrow like 1,000 instead. Then my risk would be 60,000, since it would be still like a significant risk, but it will be less than my equity, so I am fine. Or I can say, hey, instead, why don't I try investing in Procter & Gamble? So what happens if I do the same thing with Procter & Gamble? So Procter & Gamble is promising me 0.8%, which is in our case, what, $800? So 1% from 100,000 is 1,000. So 0.8% is $800. Yeah. So
Yeah, Andre.
yeah.
You wanna explain what a margin call is? You mentioned margin call.
Oh yeah. So what basically happens? Let me finish with this calculation first, and like next thing I will explain what margin call is. So my expected return is 4,800, and my maximum risk is, we've seen it's around 8%, so it's 8,000, so 48,000. Okay, so we see like return is much less, but risk is also much less, and that's basically the decision that's kind of decisions that I'm making. So about the margin call. So what basically happens when you're borrowing money from the bank or from your broker? So what they would be doing, they would be saying that you basically now, like, let's say that I am buying Tesla, and I bought Tesla at $500 per share, and I bought let's say so $500 per share. So with, let's say, like, for the simplicity of calculations, at $1,000 per share. They haven't been there yet, but might happen. So I can buy 100 shares, $1,000 a share, gives us $100,000. If I am buying with a margin, I can buy 500 shares. That would cost me 500,000, or like if I like, or even 600,000. So now I have, now I basically have two positions. So first I have my 500 shares, sorry, 600 shares that worth $600,000. Also, I have a cash position, like negative cash position of 500K. That is my loan. Makes sense, right? So my net position is still 100K. That's my equity. So nothing has changed because I just bought, like, I had $100,000. I still have $100,000, but before that I had $100,000 in cash, and now I have $600,000 worth of Tesla stocks minus $500,000 loan. Still makes sense, right? Let's imagine now that Tesla shares go down to $900. So what happens to my Tesla position?
Goes down.
Yeah, so how much does it worth now?
600 times 100, 900, yeah.
So that's 540,000 if I'm not mistaken, right? So what is my net worth now? What is my equity?
40K, right?
Yeah, it's 40K. Let's imagine now that Tesla goes down another $100 and it's now $800 per share. So my position now is
480K. You're
400.
20 in the hole.
Yeah, so my equity is now negative, right? It's minus 20K. So basically margin call happens here. So and it happens before that. Like broker wouldn't allow you to go negative unless it is some like very rapid drop in the market price. Normally you would get like an advance, I guess like sometimes before it was actually a call. And they would tell you, hey, your equity is going close to zero, so you need to either increase your increase your margin, which is like the money that you that you have, or just sell your shares before you go negative. And that is the risk. So even if you believe that long term Tesla is a fantastic thing and it will go up to 10,000, and maybe it will. But in the short term, when you are selecting your margin, when you are selecting your your borrowing strategy unwisely, and when you are taking like such a big risk, there is a case that just the short-term fluctuations will get you to the negative zone, and you will be just forced to sell your shares just because your equity can't go negative. Like your broker wouldn't allow that. That it would be.
Yeah, Andre, I think it can go negative. There was that story about that guy who owed about 120K to E-Trade because he wanted to short some position and he bought it and then he went to sleep or something and then it crashed overnight, putting him in the hole for about 120,000 because a margin call came and they automatically, drove his account to negative.
Yeah, well, I mean, that is not impossible, right? So imagine that we are still in the same situation. So today I'm buying Tesla at 700, which I think it's 690 something at close, and something happens overnight. I don't know. Elon Musk dies. So, and tomorrow it wouldn't go down slowly. It wouldn't go from 700 to 690, from 690 to 680. No, the traders wouldn't trade like that. There will be some pre-market trading, but the moment market opens, there is nothing impossible in market opening at $400. So it would actually drop between the session. So you wouldn't have time to act. You wouldn't have time to open your position while it would be slightly above zero, because this drop will be between sessions and it will be so significant that you will go negative. Yeah, that's not impossible, but that is fairly rare. Like most cases, you will be just like 99 out of 100 or even more than that, you will get a margin call like in advance and you will still be left with some positive equity. But the problem is that you will still be forced to sell, and your strategy, even if it was a good strategy and you might have made money in the long run, still if you're trading on margin, like like short term, like margin call can ruin your strategy. That's why it makes sense to look at those numbers and see, hey, how much I am risking. So like that's basically what you see, right? With a Tesla, you're quite likely to lose 30% of your money, as well as in a month, as well as you're quite likely to make 30% on your investment. So it basically tells us, hey, when we're trading on margin, be very, very careful. Okay, so any questions on that part? If not, let's go back to our portfolio thing, and I guess you should still see my Excel or not?
Not yet.
Okay, probably got unshared. Okay, so what are we doing now? So now we know that we have one risky stock and one stock that is not as risky. And the question is, if we want to have both, if we want to have some combination of those two in our portfolio, so what kind of combination would make sense? And that's basically what the whole Markowitz theory was, and that was this whole approach how to build it. So the idea is that what we will be doing now, we will be building a number of different portfolios, and we will be calculating the same two numbers, risk and return, for those two stocks. So let's say that, so both of our portfolios, they would have some proportion of Tesla and some proportion of Procter & Gamble. Each of them will have some risk and some return. So two basic portfolios would be 100% Tesla, 0% Procter & Gamble, 0% Tesla, 100% Procter & Gamble. And we already know these numbers. We know that for Tesla, for 100% Tesla, risk is 15 and return is 2.8. For 100% Procter & Gamble, risk is 4.2, return is 0.8. And now I will be doing a very simple, and that is, because that is, I will be building 100 different portfolios. Basically with all possible combinations with 1% step. At some point. Almost there. 3, 2, 1. Okay, and I'm not doing 0, 100 because I already have it. Okay, so now I need to calculate risk for each of those portfolios. No, let's start with return. Return is an easier thing. So what is the return for a portfolio that have 99% of Tesla and 1% of Procter & Gamble? Any intuitive ideas?
That's a weighted average.
Yeah, basically it's just a weighted average of those two returns. So, and it makes sense, right? Like, I mean, intuitively, if we have 99% of Tesla and 1% of Procter & Gamble, then our return would be 99% of Tesla return and 1% of Procter & Gamble return. And it's very close to 2.8%. It's almost the same as Tesla. That's what we expected. Nothing like that would be contrary to our expectations. And we can see that returns, as we go down in Tesla, they go slightly down, and at some point we reach 0.8%. So returns, like, that's what we expected. So the funny part starts with risk, because risk is not a weighted average. So we know that actually when we're adding stocks together, the combined risk is not a weighted average of two risks, but instead it is lower than that. So it is lower than that. And the risk of, like, the way we are doing that, and some of you might remember that from the class, we're saying that variance of two values is variance of the first one plus variance of the second one plus two covariances of X and Y. This should make some sense, I hope. So that's just a variance of a sum. The funny thing here that we have, since we have weights, we need to apply weights here, so to this formula. So we can't, like, because we are not having like 100% X, 100% Y. So with this risk, we would need to add weights. So it would be kind of weighted, not kind of, it would actually be just weighted variance. So the combined risk would be weight of, I will be use 1 and 2 instead of X of Y. So it would be the squared weight of, I would actually write it this way. So it would be weight of the first risk squared plus weight of the second risk squared plus 2 weight 1, weight 2 covariance of risk 1 and risk 2. So what we're basically saying here, again, to give you an intuition why that makes sense. So we're saying that if we have a portfolio of 90% Tesla and 10% Procter & Gamble, then we're taking 90% of Tesla risk, and that is variance. So variance, like our risk is a standard deviation, so variance is a squared risk. So we're taking the risk of like 90% of the Tesla risk, 10% of the Procter & Gamble risk, and we're taking two covariances weighted in the same proportion. So that's like, that might not seem like absolutely straightforward why that is the case, but I hope that at least makes some intuitive sense, right? So that we're taking like the proportion of one risk, squaring it, the proportion of second risk with the same proportions as stock have in their portfolios, and we have this like weird like covariance double weighted. Yeah, so it's fairly easy to show that it is really the case, just like from the definition of how of the standard deviation is variance. But again, I hope that it makes some intuitive sense, so that it is basically just both risks in those proportion plus this part that defines the covariance.
Yeah,
So
you're using the same formula from class, right?
yeah, that is the same formula from class. There is no other formula that is. So what we don't have here, we don't have the covariance. So we need to calculate that. And again, in class, Adam uses like, for some reason, he prefers to calculate variance manually and covariance manually. I don't think I'm strong enough for that, so I will use formula, like Excel does everything for us. If I, no, let me Google it. I think it's, okay, it's covar. Okay, so I will just give this covariance all the returns of the first stock, and order doesn't matter, so that is. And all the returns of the second stock. And you see the covariance. So remember that, like, again, when you're looking at covariance, like this is usually the number that doesn't mean anything. So because covariance is not, it depends on the original numbers. So if we want to get some intuitive sense of what this relationship is, we need to translate covariance into correlation. And correlation is basically covariance divided by standard deviation of the first stock multiplied by standard deviation of the second stock. So we can see that correlation is 0.12. So it's pretty low. That means, like, it's still positive. So it shows that those stocks move like more or less in the same directions, but they're almost uncorrelated because 0.12 is a very, very low correlation. So it means that we're having some decent diversification here. We will actually see that this portfolio will give us good opportunity to diversify risks.
How did you calculate the correlation? Can you show me that again?
So correlation is covariance divided by one standard deviation multiplied by the other.
Would you get the same number if you were to use a formula, corel?
Let's check. Like, don't trust anyone, including myself.
R-E-L. No, 2 R's.
Never trust people, and especially Russians who work in banking. Okay.
Close.
It's, I think I added 61. It's 0.1239.126. Frankly, I don't know, like, it should be the same. For some reason, we have a slight difference in the third sign. Have I included something that I shouldn't have? Doesn't seem so. Oh, is it because of the sample, and it might be the sample versus population measures, and it might calculate it by default. Like, you remember that, like, there was this thing with dividing or by n and divided by n+1.
Yeah, you had standard deviation, right? what did you get the, yeah, what,
Yeah, so the standard, yeah, so the standard, like it probably has something to do with the fact that one is using like the population and the one is using sample. But you can see they're fairly close. So
Yeah.
I guess if we find out which one is which, and like we'll make them the same. But yeah, pretty like that's pretty much 0.12 is the correlation. So now we can simply apply this formula. So remember that we have to have risk here. So that's how we calculate like the squared risk. So we will need to have square root of this whole thing. So let's go again. So that is first weight squared times Tesla return. Where is Tesla return? Tesla return squared plus second.
wait, is it weight multiplied by risk square?
So that
Or
is,
did you do a weight square?
well, that's the same thing, right? So risk multiplied by
Oh,
weight, everything squared is the same as first squared multiplied by the second squared. It's
okay.
the same.
Okay, you expanded that. Okay.
Yeah, I like less parentheses. So the second, like 1% of Procter & Gamble squared multiplied by and actually I have used return instead of risk. That was wrong. So that should be C2. So multiplied by risk, sorry, that should have been 4.2, and that is multiplied by 15. Okay, so 99% of Tesla risk. So 99% of, yeah, that's should be vice versa. So we have 99% of Tesla risk, all squared, plus 1% of Procter & Gamble risk, all squared, plus 2 times 99% times 1% times covariance. And this one, like the way to check it, we know that this risk should be fairly close to 15, right? We have diversity, like we only invested 1% in Procter & Gamble, so risk should go down, but not tremendously, because it's still like 99% Tesla portfolio. Yeah, and we can see that it's 14.8, so it's fairly close. Okay, and I forgot the covariance. Okay, and we see that risk is going down. So now we have risk, we have return for all those portfolios. And we can now take a look at what do we have if we build scatter plot. And you can see this thing that we had in the textbook, and that's pretty cool that we got it, right? So
Beautiful.
Yeah, and I see one point which is weird. That shouldn't be this one point. So this.
You can remove it. That's one thing Wendell taught, right? If you see an outlier, that could be. But I don't actually see any outliers there.
No, that's. I think something is.
What are the values for those?
It's 0.4. So risk is 0.4, and actually that's a good. So that is probably this one. So that is my 100% Procter & Gamble portfolio. Yeah. So something is something is not right, because portfolios with close to 100% Procter & Gamble should resemble Procter & Gamble, and they are not. So their return is right. So their return is close to Procter & Gamble, but risk is too high. So it's showing like 20% risk. So, and actually that is wrong, because risk for Procter & Gamble only like this should be close to 4%. So let's check the formula again. So that is, so we're taking 99% of Tesla risk plus, let me check if everything is copied correctly. So 98% of Tesla risk squared. Oh, okay, I didn't square this second part. I see. You see, I haven't. That's what she's talking about. I should be squaring both things. Okay, now we're here. So it actually it is still this like parabolic curve, but it is like it's more like this whole like it's sometimes called Markowitz bullet, because it reminds of a bullet, and it's not like this whole thing. It's slightly curved, but not as much. So that is, but you would see like if those stocks were resembling one another, like I think if they were like closer to one another, I get that would become more like a little bit more like a bullet. So
can you scroll down? Did you get the risk close to 4.2? Okay.
Yeah, it's quite close to 4.2. Yeah, we can try and let's try and replace just like I think that this shape is like it's not like showing like the bullet, and we would like to see something more interesting. Let's replace one of the stocks with something else. Any other ideas? What is that we want to get?
You mean like instead of P&G or Tesla?
Whatever. Let's just try some other combination quickly. Any ideas? What kind of portfolio?
Are you looking for a risky stock or safe stock?
I would say let's try and replace. I mean, like I would try and replace Tesla with something. Like let's try and replace Tesla with, let's say, Microsoft.
That's not very risky.
Yeah, so we would like it's still more risky than Procter & Gamble, but disparity in those two would be not as high. So we might see like the shape might be closer to textbook.
You're trying to increase the correlation, right?
I'm trying to basically I'm trying to make sure that returns and risks are closer. So I can't say anything like correlation would change the shape.
Yeah, I think what Mary Alice says makes sense. Just change the numbers, right? You don't have to exactly.
That is, yeah, I don't disagree. That is possible. So I just want to keep it more or less real, because the moment you just start changing number, that becomes so much like a textbook exercise, and I want to make sure that like there are real stocks that behave this way. So and now that we have it, it's actually we can do that fairly quickly. So we have this whole Microsoft data. So I'm just taking this whole columns that calculate returns and other stuff. So I'm just copying it here. So I have my numbers for Microsoft. So those are those are 0.23% for, so that's Microsoft. So what do we have? We have 0.23 as as a return. And we have 5% risk, so much. Actually, that's quite interesting, you see. So, so we have not much higher risk with Microsoft, not much higher risk than Procter & Gamble, but at the same time, we have much higher return. So that is, maybe let's like now we see that Procter & Gamble is not such a great stock, right? So we, I will just save that. So we see it's not such a great stock. So why don't we replace Procter & Gamble with Microsoft? Because we see that Microsoft has similar risk and much higher return. So now what we're doing now we have our 100% Microsoft portfolio.
You mean similar return but much lower risk?
No, similar risk. You see, like Procter & Gamble have 4.
Oh, you were comparing with Procter & Gamble. Okay,
yeah.
I was looking
yeah.
at yeah.
I will keep Tesla like that's our investment decision. We want to have some balance between like risky, like some risky stocks and less risky stocks, and we tried like combining Tesla with Procter & Gamble, and we see that hey, like not like Procter & Gamble is really not like not the best thing here. So it is, we can replace it with something that has similar risk but much higher return. So now let's try like Tesla Microsoft. So 100% Microsoft would give us 5% risk, 2.4% return. And now the same portfolios, I would just change like all the C to D. And this one as well. And I need a new covariance. So I need a covariance for Tesla and Microsoft. And you actually can see that we're getting close to building portfolio of 3 stocks. So Tesla. So that's my Tesla data. That's my Microsoft data. Okay, so I have my new covariance, so I can now make sure that we're using the right covariance, that we're using return seems to be right. And I will just copy.
What if you had to do, are you doing all 3 stocks at the same time?
No,
right?
just 2 for now. Just 2 for now, and something went wrong, as you can see. So
how do you expand the formula if you have to do 3 stocks? Is it variance of X?
We're almost there. That's the next thing that I was gonna do with 3 stocks. So let me fix this one. And so we're using Tesla. So 99%. 99% Tesla. Okay, I haven't squared this one again. This needs to be squared. 1%. Okay. Okay, so 99% squared times,
What is F22? That's like a blank.
that sounds wrong. So it should be Tesla. Yeah, let me replace this. Let me actually do the whole thing. So it's 99% squared times, the good thing, guys, you will remember this formula very well. So weight of Tesla squared times risk of Tesla squared. That was the purely Tesla component, plus 1% weight of Microsoft squared times risk of Microsoft squared, plus 2 times weight 1 times weight 2 times the covariance. Okay. And covariance shouldn't be changing. D3 shouldn't be changing, and B3 also shouldn't be changing. Okay. Okay, now we're here. Whatever is on 5.5. 0.82. Now let me check the return. Times. Now the return is weird because 99% Tesla. $2.8. It shouldn't go down to 1 because actually Tesla return is 2.8. Microsoft return is 2.4. They're quite close. Actually, that's another interesting point here, right? So we just replaced Procter & Gamble with Microsoft, but we could have also argued that, hey, Microsoft offers pretty much the same return as Tesla over the last 5 years. We can see that, but 3 times as much risk. So what is going on there? So 99 times 2.8 plus 1 times 2.4. Okay, here we are, finally. Yeah, and well, again, like this combination, I guess it might do something with the fact that maybe if covariance was higher, just for the sake of simulation. Now, actually, it makes it even steeper. Maybe if covariance was lower. Yeah, if covariance was lower, actually, that would give it this more bulletish shape. But even the way they are, we can see that there is some set of portfolios, like on this left side, that doesn't make much sense because there are not too many of them, actually, in this case, or in case of those 2 securities. But all those portfolios don't make much sense because they have the same or lower rate of return and higher risk. So that's the way we're doing it with 2 securities. If we want to expand that, and if we want to have portfolio of 3 securities, the logic would be the same, and actually the same formula, it wouldn't change very much. So we had this squared risk of the first security plus squared risks of the second plus 2 covariances. If we have 3 securities, the risk would be still squared risk of 1 security plus squared risk of the second security plus squared risk of third security plus doubled
square or raised to
Yeah, squared. That's like all basically the same thing. So like squared first, squared second, squared third, plus all pairs of covariances. 2 covariances of Tesla and Microsoft, plus 2 covariances of Tesla and Procter & Gamble, plus 2 covariances of Procter & Gamble and Microsoft. So the same, basically the same logic. It is like squared variances plus all possible pairs of squared covariances. And the way to represent that, and what people sometimes do, and it's quite a nice way, it's called like covariance matrix. So what people do, they make a matrix with where rows and columns are stock, and you can see I'm doing that right now. So, and what we have here, so the diagonal would be basically variances. So for test and variance, and variance is basically just covariance with itself. So basically each of those would be just that's why it's so convenient. So basically each element of the matrix would be just variance of those 2 stock. So covariance of those 2 stock. So covariance of Tesla and Tesla is the same as variance of Tesla, and covariance of Procter & Gamble and Procter & Gamble is basically variance of Procter & Gamble, which is squared standard deviation, and covariance of Microsoft is with itself is a squared standard deviation. Now we know that Procter & Gamble and Tesla is this one, Procter & Gamble, and we have 2 of them, and that's another nice thing. So we already have 2. So basically we'll be just summing up this whole thing. So we have Procter & Gamble with Tesla once again. We have Tesla and Microsoft. I have already calculated that. And Microsoft and Tesla, the same thing. And one thing we don't have yet is Microsoft and Procter & Gamble. We need to calculate. So that's Procter & Gamble. That's Microsoft. And that's the final covariance. So what we have just built is called the covariance matrix. And it's, so basically now, if we have weights, so the way we're going to use this, and I wouldn't be using like all the combinations because it's quite tiresome, but let's simulate a few. So Tesla, Microsoft, and Tesla, Procter & Gamble, Microsoft, risk, and return. So let's start with 100% Tesla, 0. And the biggest problem here is just we need like all these combinations. So 90, and we have 10% left. So that's basically we need like 10 ways of. So we need like all these things to sum up to 100. That is, and you can imagine that like number of combinations we have to test with 3 stocks is much higher, and that is the biggest problem of doing like real portfolios with Excel, but we can. Like I will make several of them, and probably like not all of them, but some of them we will make. So let's calculate returns as previously. Now we have 3 stocks, and return is the same. It's just the weighted average now of 3 stocks. So 100% of
check the Microsoft column right quick, just to make sure. Sorry.
Oh, okay. I have copy pasted it. It should be 100 minus this. Yeah, thank you very much. That is, you're absolutely right. Okay, so that's the return. So 100% of Tesla times the return of Tesla plus 0% of Procter & Gamble times the return of Procter & Gamble plus 0% of Microsoft times the return of Microsoft. Okay, so returns would be the same, will be the same, and let's can show them nicely. Huh? Yeah, that's something. Oh, I got it, because those are that should be 90%, not 90. Should be 0%, 1. Okay, that was the easy part. Now let's do the risk. So basically the same thing. So Tesla weight squared times Tesla variance squared plus Procter & Gamble, and that shouldn't be changing, plus Procter & Gamble squared times Procter & Gamble variance also squared plus Microsoft weight squared times Microsoft variance squared. Almost there. Now 2.
Don't forget to lock the Microsoft cell reference.
Yeah.
Oh, well, you did. Sorry.
Yeah, I just did that. Thanks. So 2 times Tesla weight times Procter & Gamble weight times Tesla Procter & Gamble covariance right here, and 2 more. 2 times Tesla times Microsoft weight times Tesla Microsoft covariance. Tesla Microsoft covariance. And the final one, 2 Procter & Gamble Microsoft and their covariance. And we are done. And that should be, the risk should be quite, like, we should already have this 4.9
You have to take the square root of all that.
Sorry, come again.
I said you have to take the square root of that. Also,
Oh yeah, you're absolutely right. That's what we didn't do. Square root of this whole thing, and we see 2 point, and that is 100% Tesla, and that is weird because that should be exactly 2.8 because everything else would be zeros. So let's check what we got wrong. So Tesla. So the bad thing if I copied something like I think you see. I see. So this is a very unstable. It's already squared. I already squared that in the table. So we don't need to square the diagonal.
I didn't catch that. Could you try again?
Okay, and that is 14.95. Yes, and it's exactly the Tesla. Okay, it seems we're good now, and we can calculate. Should be slightly going down. It slightly goes down. Okay, and then let's have 80%. So again, and with 80%, we technically need to take all possible combinations of how to split those 20% in, how to split all the 20% between those two stocks. So there will be more combinations right now. I will stop at some point because that would be like, that would take us forever, but that's basically the logic of doing that. So these calculations, they're exactly the same. So let's go with, so let's make a few of them because that would be like, again, going through all 70. So we can like just in the interest of time. So you can see how that it's not very. It doesn't look very.
If you zoom in, are they parabolas?
I mean, yeah, we probably don't have, like, we need more combinations for that. Okay, so I can send that across. So if somebody is interested in getting like, but now you see like why doing that in Excel with two stocks, like with more than two stocks, is a fairly difficult exercise. So and that's basically why people are not doing that in Excel. So let me quickly show you what, like, and again, like, we're still like 10,000 miles away from what people actually do in the industry, but we're getting a little bit closer. Okay, so so let's get the data. So we had Tesla,
Is this from that Quantopia website?
Oh, that's my pure Python code that I basically wrote for this exact purpose. I tested some different scenario, but so we had Tesla, Microsoft, and Procter and Gamble, right? And Procter and Gamble is what is it PG? What is the?
Yeah.
Okay, so what actually happens? I
feel like this escalated exponentially. But that looks cool as hell, Andre.
Yeah. So what like that's what I would do. I would just say what stocks I need. I would run that, and you see it's downloading data. It has downloaded my data. Saved
Where is
it.
it downloading from?
The same. It's a Python library called YFinance. It's basically a wrapper for downloading data from Yandex Finance. So then I have this, and
So Yahoo Finance has given an API library.
no,
for you.
they used to have it. Now they don't have an API, and that I think it's just like somehow scraping it from the site. That's unfortunately they don't have a native API. It's sort of like the free one. Okay, and something. Oh. Just save it. Didn't save it to the right file. Okay, now I hope I did. Now I can. So basically it's doing the same thing. And you can see, so that's our 3 stocks. And you can actually see it is that like we basically got this part, the most risky part with lots of Tesla. And that's what we simulated this upper top corner. So if you remember like how it looked like a few stocks here, a few stocks here, and a few stocks here. So that's how it looks for the 3 stocks, and that's an efficient portfolio. So now you might, and like now it's going to get a little bit nerdy, but might be interesting. So
sorry. So what did the code do so far? It downloaded the data, ticker data, and then what did it do?
Same exact thing. So it downloaded the data. It built the covariance matrix. You can see right here, it is my covariance matrix. And you can compare the numbers. It's exactly the same numbers. And then it generated, so basically those are 10,000 random points, which like 10,000 random weights, for each of which we calculated risk and return, and we just plotted them together.
There's a negative weight in there, right?
Once again?
It says the most profitable portfolio weights are like a negative. Is it a negative weight?
Oh, that's like we haven't got there yet. Yeah. So that was my like next question. You see, it's not a parabola, right? You see, like actually, it's somehow like this efficient frontier. It's expected to be somehow parabolic, but it's not. And the reason why it's not, that this whole like theory about like Markowitz efficient portfolio, it will always have this efficient frontier that will be a parabola. But this theoretical frontier would have some negative weight. And that would mean, like from practice, it would mean that we would buy some stocks and we would sell, and let me add, this code actually does something more than just simulation. It uses, you actually can calculate efficient frontier with some nice linear algebra thing. And you can without any simulations, you can't tell what the efficient frontier would be. But the problem with that, like with this whole theoretical model, is that, and you will see it now. Okay, so you see like black dots, those are our three stocks. Tesla, like this is Microsoft, this is Tesla, this is Procter & Gamble. So this is our simulation, and this is the real efficient frontier. So you see quite quickly, so the difference between simulation and theoretical efficient frontier.
Rob, Daniel.
Is this, do you have this exported to a spreadsheet?
We can see
No.
this. We can see the program that you were running. I think that's all I
Is
got.
Yes.
that your own code or is that something you use for work?
Oh, that's my own.
Yeah. How many lines of code is that just for that analyze.py?
So can you see what I'm showing? No, like
No,
my.
no.
It shows all the code.
I can
Oh
see
my
the
God.
IDE.
Oh, you can't see the font.
Now we can
Oh,
see
there we
it,
go.
yeah. I was like, oh, cool, you're just pointing to all these codes. That's, yeah, I see what you're talking about.
I was like,
no,
I don't think this is what we're.
Yeah, now you can find like that. That was the purpose of all that. So now you can see the fun part. Yeah, so that's the result of this simulation. So all the blue dots are the simulated ones, and all those they're having like those are our like positive weight portfolios that like. But the real efficient frontier, that is like the theoretical efficient frontier, that is a red line, it diverges from this simulation, and it diverges exactly because like it goes to negative values. And this point right here, it's actually that is 119% of Microsoft, minus 33% of, so we're selling short basically, it's minus 33% of Procter & Gamble and 13% of Tesla.
But what does it say negative? I don't see anything negative in the axis.
Because we're only risk and return. But I'm telling you, I'm seeing that from the output that this point, because you don't see weights here. You see all these like possible portfolios, but you don't know what those portfolios are made from. And
Yeah, that's why I was asking what the negative weight before, because it showed that for Procter & Gamble.
Yeah, and like these parts, these actually have a negative weight for Procter & Gamble. That's where.
Put options, right?
You're basically selling short.
So which one are you shorting? All of them? So you're selling short. Which one?
Procter & Gamble in this case, because it's the worst stock in the bunch, right? It has, if you think of it, it's logical, right? So you have two good stocks that one has low risk. No, let me put it like that. So Procter & Gamble is worse than Microsoft because it has pretty much the same risk and much lower return.
Right.
So Procter & Gamble is also worse than Tesla because it is, no, that is like, I would just say like in this bunch, it is like, it's kind of the worst one because you see it is so, so if you want to get pretty much this level of risk of 0.5% more or less, 4.5, you wouldn't buy Procter & Gamble because it has pretty much the same level of risk and it has much lower return, like 2.5 times as low. So that is the worst stock of the bunch. And the idea is that you say, based on those two numbers, you say, hey, this is the worst stock. So it would probably, like, we expect that it would be underperforming the other two. So, like, let's just sell it because it would probably lose in value. That's the intuition about, like, it's been negative in these portfolios.
Would we see the risk percentage in any other websites, or do we always have to put that in an Excel sheet and calculate it?
You will. Actually, that's a good question. So let me check. I think you will in,
Well, if you have to calculate the monthly, then you have to download it anyway, right?
I'm just looking at the website if it would have, it usually have some statistics, but I don't.
Because I'm thinking even if we don't do the efficient frontier, if I want to decide between a few stocks, I could always download it, calculate the risk and the return, and then sort of arrive at the same conclusion, right? What we did with P&G and Microsoft, risk versus return. We are getting almost it's almost the same risk, but a worse return with P&G.
Yeah, and the thing is, like, the thing with P&G, you might be asking, hey, if P&G is such a bad stock, so why people are still trading P&G? And we might find that, for example, if we're doing the whole same simulation and calculation, but instead of taking 1 month, we will take like 1 year intervals, then this whole thing might be very, very different. So it might become that, like, on the 1 year horizon, P&G has a much better combination of risk and return. For example, it will still have like a good risk, and it would have like low volatility. So it might, like, some stocks might make sense for one portfolios, but not for the others, and vice versa. Yeah, so if you, I can also show, like, as a final touch, a few, I will try to share the whole desktop so you can see all the screens. So I have a few like simulations with, basically what I try to simulate in this code. I have, I had an idea, and that's what I would like. That's the why we would use this kind of like analytics. So imagine that, like, we have a hedge fund and we have some investment idea. So if we're individual investors, we would probably say, hey, I would just buy the index fund. It probably has like more or less good combination of various stocks. But if I have a hedge fund and I have some investment idea, I still need to analyze like risk and return. So my investment idea was, hey, what if I take companies led by females? So there is this whole like concept that maybe like female-led companies are overperforming those led by males. So I didn't test that. I just said, hey, that's my investment idea. I will build efficient frontier for that. So, and you can see, like, you can see how it looks for 3 stocks. And what I'm trying to show here, how would it change, like, the results of the simulation when we're moving from like just a few stocks to multiple stocks, answering like what happens when we're adding more stocks to the bunch. So those are just 3 stocks. You can see, like, that is the frontier. Let's add one more. Those are 4 stocks. So it's actually still, you see how different they are. So that's.
So what was the conclusion about the female-led CEOs?
I haven't analyzed if it's better or worse than S&P. I didn't do that. That wasn't basically my idea. I just use that as a as a way to pick stocks to my portfolio. So when we move up the chain with 5 stocks, so more stocks we add, like, so you see that this theoretical efficient frontier, it's always had this parabolic shape. But the more stocks we add, the more, surprisingly, our theoretical efficient frontier starts diverging from the actual one. And And what I will finally show, I will show you the whole.
So what does it mean when the theoretical is diverging from the actual one? We didn't do the simulation right, or?
I will show you the, like, so this is the whole portfolio, 29 stocks. And you can see that this like simulation with random numbers. So basically this is a mix of two things. So first of all, simulation with random numbers is not ideal because it doesn't catch extreme cases because random stands to be grouped. But it's sorts of like, but the idea is that it actually gives us, so this whole combination of a blue circle, it actually gives us, it's very close to, you will see that this blob is very close to S&P. So this return about 2% and this risk about 4%, that is basically, if we're not like, if all the weights are positive and we're diversified in this way, we will be getting like expected return and expected risk of very close to the market expected risk and expected return.
So the blue are the returns. What are the black dots?
So black dots are individual stocks,
Okay.
and blue are all these like simulated portfolios. And you can see from like from this one. So that is the like that is this like top point here. So you can see it has like 7% of the first stock, 27 of the second, 5% of the third, minus 21 of the fourth, 19 of the fifth, minus 43% of this. And some are just, I mean, minus 44%, like there is some really bad stock from this, like from the combination, like 44%. But this is like, actually there is an investment strategy based on that. It's called like the long short strategy. It is based on the idea that if we have some factor that would be, that we can use to say that those stocks are good and those stocks are bad, we're basically taking the whole S&P or like whatever our universe is, and we're dividing all the stocks like by good and bad, and we're keeping like, we're buying long half of the portfolio and buying short like another half, and we hope that our like our position at any point of time is close to zero because it's balanced, but the return would be slightly positive. But that's like, and that's what some of the like this hedge funds and like investment banks do, and but that's like, frankly, that's insanely difficult to make it profitable. That's why most of these funds are actually not overperforming just the index. So that I'm like, but that's, I hope that gives some intuition in what is going on inside of this stuff. So that is like, make it like way more difficult, add like 100 different factors, much more data, and like much more analytics, and that will start being close to what all these like quantitative firms are doing.
Thank you, Andrei.
Yeah, and somebody asked about number of lines of code. Not too much, just like around 200.
Oh, that's not bad.
Yeah.
So did you were you a coder before you became a banker or after?
Yeah, I'm not a real banker. I still work in IT, so yeah. But yeah,
Oh, you're right. Okay.
Yeah.
But he works for the bank, right?
Yeah.
So
Yeah,
investment bank.
Not the same thing. Not the same level of pay.
No, but they actually, people who are actually doing the investment banking, right? They have a team of quant analysts who would actually run these numbers and then tell them what to pick.
Pretty much, yeah. It's getting like pretty much blurred now. So like we believe that it's, and I think it's already happening in some like funds that actually every person working there is an analyst can code, and every coder can analyze. So that becomes, so it makes some sense, right? So rather than like splitting completely people who can come up with ideas and then they go to their IT guys and like quant guys and to ask them to code that, You probably need a few like hardcore coders who can like optimize stuff, like do the infrastructure, but simple things like just like testing your ideas, like writing a few lines of code, like pretty much everyone can do that. Okay, am I still? Yeah, I will stop.